We've talked a lot over the years about zombie companies, those companies that have not been able to make any principal payments, let alone all of their interest payments, for at least 3 years. But the banks and other lenders don't want that to show up on their books, so they loan them the money so that they can at least make most of their interest payment. And then any excess goes on, and so what they're really growing is more and more and more debt. Well, the IMF just came out with a report on it, and I think you really need to know about it. Coming up. I'm Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies. Because everybody's life, while we all want to maintain a reasonable standard of living, everybody's life is a little different. And you need to put your goals first. I'm going to tell you, if you haven't subscribed yet, go ahead and click that Calendly link and set up a time to talk to one of our specialists and get your strategy in place and get it implemented ASAP. Because quite honestly, the zombies are coming for you. So let's talk about this. The IMF just did a paper, The Rise of the Walking Dead, Zombie Firms Around the World. The term zombie company was applied to Japanese firms supported by Japanese banks during the period known as the Lost Decade. You've probably heard of that. After the collapse of the Japanese asset price bubble around 1990, so in the early 90s. Now, I could tell you that even through today, those assets have not recouped. And residential real estate dropped 85%, commercial dropped 95%. Opportunities are ahead of us. But Japan, thanks to Japan, who introduced this, zombie companies are indebted businesses that, although generating cash, after covering running costs and fixed costs, wages, rents, rates, rent, only have enough funds to service the interest on their loans, but not on the debt itself, and not all the interest, by the way. As such, they are generally dependent on the refinancing of maturing debt for their continued existence and may face solvency risks should interest rates rise or investors withdraw from further financing. So we need to keep this hidden. Do you not remember back in 2020 when the government just opened the money spigots and interest rates at zero, encouraging all of these zombie companies to just keep walking? And isn't that what they did in 2008 as well? Have you thought of Citicorp as a zombie company? And yet we bailed them out. We taxpayers bailed them out and kept them alive. Well, is that going to continue? I don't know. Let's take a look. Figure 1 shows several interesting patterns. Here's figure 1. First, the share of zombie firms for both listed and private firms has been steadily increasing over the last 20 years, especially after the great financial crisis, so 2008. Low interest rates, ample liquidity, and search for yield may, because we don't want to take any credit for the mess that we're in, may have been related to this upward trend. But what I would really like to point out to you in here is that the gold are the private zombie companies, and yep, they're up. But gosh, in 2000 is when they started listing these companies that were zombie companies, transferring the risk from the private world into the public realm. So when I say that they're listed, they're on the stock exchange. So you're not going to know this, right? Is your stockbroker or whoever is helping you make these choices, do you think they understand this? And if you want to be sure, how about having a conversation with them and say, hey, tell me about the zombie companies. Do you know whether or not I own any of these zombie companies? Because their life or their appearance of life, which is a much better way to say it, is based on being able to continuously borrow more money. I don't know, kind of like the governments, right? Do they ever reduce the debt? No, they don't reduce the debt. They just roll it over and borrow more. And it's the same thing here. But when you're at the end of a currency's life cycle, doing this becomes a challenge. And so now, as they're trying to roll over this debt, they're doing it in a higher interest rate environment. And, they were supposed to retire the debt and reduce their balance sheet. Instead, because of the 15 years of zero interest rate policy, they didn't reduce that debt. Yeah, they rolled it over, but they actually took on more and more and more. So we've got a big problem if they couldn't pay it in an easy environment. How in the world are they going to pay it in this much harder environment? And what do you think is going to happen when this time bomb explodes? Because our entire system globally is incestuously intertwined. So it doesn't really matter which fuse ignites the bomb. It's all going down at the same time, really. They'll try and postpone it as much as they can. But here's Japan's share of zombie companies, right? That is pretty big. Where does the U.S. sit in here? Oh, right there. We're not that far down. And in fact, we also show novel results pointing to reduced credit supply to non-zombies that compete with zombie firms. So in other words, you've got corporations that are earning enough to pay their interest and part of the principal to reduce their debt. Remember, there's two different kinds of debts. There is self-liquidating debt, and then there's non-self-liquidating debt. This is a perfect example of that. A non-zombie company would take on debt to expand their company, make more money, and use that money to pay off that debt. But then you have the other kind of debt where these banks are giving them that money to zombie corporations that they know can't even pay all of the interest and forget any of the principal. Well, in an ample reserve environment like we've been in, where there's just so much free money around, well then, okay, banks didn't need to make, or whoever's financing this private credit, they didn't need to make that choice. But we are also in an environment with tightening credit. So increasing interest rates and tightening credit, these entities are going to have to make choices, including governments. They are going to have to make choices on who gets new debt money. We rationalize that this finding with evergreening motives from lenders who face incentives to extend credit to zombies to avoid recognizing the losses in their balance sheets. And, we can also talk about this with the governments and the central banks, that when we get into an issue, the fact that the whole system has been zombified needs to be hidden with lots more money printing, keeping everybody that they can alive or appearing to be alive. But again, we're now at the end. So how can they do this? They can't. And the other problem is that the duration that corporations remain in status. So typically, they'd either go out of business or they become profitable again, which was really the original goal. Okay, if we can keep them floating long enough, maybe they can become profitable again and therefore not be a zombie company anymore. But, and I don't know because I don't watch those zombie shows, but do any of them turn back human? I don't know. Maybe some of you guys know the answer to that. But it means that through this whole practice of cheap and free money printing, they have just extended the life, which means the debt is going to be a whole lot harder to roll over and to service because they have more and more of it. There's 2007, you can see, as the system went into death throes before the public noticed in 2008. Look at how much higher zombie companies are, zombie corporations are, than they were then. And again, this is about risk transfer, because now it's been transferred to institutional investors that buy this crap on your behalf. How do you feel about that? I don't feel good about it. As an ex-banker, as an ex-stockbroker, I own none of that crap right now. This is what I own. Plus food, water, energy, security, barterability, wealth preservation, community, and shelter. This is where I put my wealth. The average number of years a firm remains zombie has been gradually increasing over time, standing at roughly 4 years after a firm is first classified as a zombie. So basically, it takes 3 years before they can even be classified as a zombie, and then another 4 years after that. And that's only because this only goes to 2021. And we certainly saw what happened with all of that free money. And then the Fed decided to raise rates after 2021. So I don't know. Do you think with the advent of what's going on in these markets that there might be even more zombie companies than what you're seeing in this graph? Yeah, I think so. And what are the markets saying to the Fed? Pause, 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 pause. And they got it, didn't they? They got that pause with a threat that they're going to raise the rates a couple more times this year. But let's see. With a potential Fed pause on the horizon, investors are shifting into high yield ETFs. What's high yield? It's junk. It's crap. Why people don't make that connection? Is this the time to be in junk? No, in one word, no. Even the bonds, even the treasury bonds that they want you to think of as risk-free. Oh, I've been telling you for a while now, we've been watching that market become less and less liquid. So this is really where the problems are going to show up first, in the junk, in the zombie, in the high yield markets, in the leverage loan markets. And it's not going to be pretty because we have this wall of maturing debt. So even though the Fed paused, okay, then what did the traders say? Risk on, baby, risk on. And so they dump lots of money. And I'm seeing this happen all over the world, quite honestly, as the central banks look to pause their rate increases. Have they conquered inflation? The inflation that they created? This pause, even a little bit more rate rises, are we going to repair the purchasing power? History tells us, no, we are not. Not going to happen. So don't be waiting for it, honestly. And this is not the time to take risk. I would rather be, I don't care, 10 years too early than even 1 second too late. Because in that 1 second, you lose all choice. And what are we talking about? Oh, yeah. U.S. corporate profits look a bit shaky. Profit-led inflation is ending. Margins will come under pressure. This is such an interesting graph because the green area here, this is labor right here, and you can see that their income, even though we've had a pretty good run at it and it's up a bit, really has not expanded as much as corporate profits. But hey, we're not saying that corporate profits led into having this rapid rise in inflation, or even the CEO pay or benefits or bonuses or all of those things that they shift out of the corporation, leaving the corporations a lot more risky. Yeah, no. And by the way, this is CPI right here, and it looks like it's come down quite a bit. That could put some challenges to inflation-led profits. But you can see in the past raising wages, falling profits. So that was a wage-driven inflation, which is what the Fed and global central banks were so nervous about, that people would ask for more money. So they had to tamper that. They absolutely had to tamper that. And as you saw earlier, it's working. But this was an opportunity for corporations to boost their profit margins because people were aware of the inflation and they were willing or forced to pay more, making corporate profits soar and justify the trading on the stock market. But if that whole piece is shifting, what do you think that does to the markets? To if you're holding anything in there. And then the next question is, how much longer will banks and governments and central banks support the zombie corporations? It's like we're in a game of hot potato and they're just passing the potato. Who's going to drop that potato in the end? Who's going to then get hurt the most? The zombie corporations that's taken full advantage of the cheap money and have used that money to pay out dividends, to buy back stocks, to make the shareholders richer. Well, that money, once it leaves the firm, it's not going in there to help them pay anything else down. And we do know they borrowed a lot of money to do these special dividends. So who's left holding the bag? Are you, the people that trusted institutional investors and have put you in this garbage. Because, hey, baby, it's risk on again, isn't it? And they're doing this just as junk loan defaults surge as higher interest rates start to bite. Duh. I mean, this is not rocket science. This is actually pretty darn simple. If you borrowed money at 0% interest, and now all of a sudden you have to pay 5% interest or 7% interest, those payments are a whole lot higher. If your income didn't keep pace with the rise in how much that was, you got a problem. And default rates are ticking up. Are they going to keep going higher? Well, what's the Fed say? They say, now we're going to see if this is true or not, but they say they're going to raise rates 2 more times this year, 1/4 point each. It's not going to do crap. We are entering the phase of hyperinflation. We've got to have a huge crisis because they have to shift us into their next iteration of money and control, the CBDCs. Don't go there. I vote with my purse. This is my vote. There is a payment shock unfolding among the weakest issuers in the loan market. And of course, it always starts with the weakest. So you've got to pay attention because they're the canary in the coal mine. Bank analysts and rating agencies expect defaults to rise further as market expectations shift to interest rates staying higher for longer and as the lagging effects of successive rate rises are felt. Because it takes 12 to 18 months from Fed policy till it works through the economy and they see the results. So we are only now seeing the impact of the rate rises that they did 18 months ago, 15 months ago. We have not seen the full effect yet. Of course, once we go to CBDCs, as they say, they can have their finger on the button constantly. 24/7. You're not spending enough money because, hey, we're a consumer-driven economy. All right, let's drop those interest rates lower and eat your principal more. Noticeably, when you see that, what do? You go out and you'll put your money in anything that you think can hold its value the best. But what's proven to hold its value the best? Right here, baby. That's what is proven to hold it the best. And silver will maintain it. But gold actually does hold it the absolute best. This total in defaults exceeds both 21 and 22 combined. Well, it's going to because we had the free money. right? And that ended basically sometime in 22. But for this total to exceed it, you got to know pattern shift, pattern shift. Take heed. You don't have to understand necessarily what it all means, but you know that when you see a pattern shift, it means something. This is not good. This is not good at all. Powell wake-up call means more corporate defaults, and that's from Credit Weekly. Oh my goodness. The maturity wall is starting to rise as quantitative easing fades. Quantitative easing did not work. Admittedly, central banks all over the place are coming out and saying quantitative easing, all this free money, I wish they could run out of it, did not work. And now he's getting a wake-up call because corporations are defaulting. Shocker. But what was encouraged with all of that was to go to shorter and shorter and shorter term rates. It's kind of like what's happening in the mortgage markets here in the US, where most mortgages are 30-year fixed. You have some variable rate, you have some shorter term, but most of them are 30 years. So with rising rates, the people that are sitting on those cheap mortgages, they're not likely to sell them. In Europe, on the other hand, they're only fixed for typically a certain period of time. People don't have 30-year fixed mortgages. So as interest rates go up, well, they're going to have to pay that higher rate. And the same thing, when they put in quantitative easing, it was to encourage corporations to take their longer-term debt, roll it into shorter-term debt at really low, at zero interest rates. And so they did that. And you can see high yield debt has shortest maturities on record. And all that debt, this maturity wall, is coming due now and has to roll over. If these monetary conditions continue for as long as the Fed says, we're going to see a lot of mortality in the corporate sector, and this process is only just starting. Zombie corporations are about to become very, very obvious. Very, very obvious. And what will this do to the stock and bond markets? Makes them even more vulnerable, even more sketchy. But you know, history also supports the long-term benefits of owning gold. So in a recent survey from gold.org to central banks, they say historical position remained the most relevant factor in organizational decisions to hold gold. Sure they do. Why? Because quite honestly, history shows us that every single government that's gone to pure fiat has abused that privilege, and ultimately ended up with a zero purchasing power and into hyperinflation. So what's the only asset that really protects you from that? That's gold. I mean, this is, again, not rocket science, because gold has the broadest base of functionality because it is used in every single sector of the global economy. So it has the broadest base of buyer. This fiat money garbage is only used in one area, the financial sector. So when demand is gone in that sector, what do you have? You have markets implode, and you have wealth destruction of any wealth that's held in here. But the flight to safety always goes here. That's why you're seeing central banks buying the most gold that they ever have in history. The second is its performance during times of crisis. Its long-term store of value, so its inflation hedge, the effective portfolio diversifier, no default risk, and it's a highly liquid asset. When fiat money assets are not liquid, meaning that you can't easily buy them and sell them without a huge price dislocation. Because you've got the broadest base of buyer with physical market, yeah, that's different. You always have a buyer. So when we're going in this, what do you really want? Do you want a little Swiss Army knife? Or do you want a flippin', here's your Swiss Army knife, and guess what? It's broken, so it doesn't even work very well. Here's your bazooka. It's got everything. Performance during times of crisis is the second most relevant reason central banks buy gold, but it's also an inflation hedge, runs no counterparty risk, has the broadest base of demand, and it's completely outside of your system, outside of the system, completely decentralized, completely invisible. You hold it, you own it. I mean, come on, any questions? So if you haven't done so yet, make sure you hit that bell to subscribe. We'll let you know when we're going live. Start your gold and silver strategy by clicking that Calendly link below and then get it executed ASAP. Leave us a comment, give us a thumbs up, share, and keep in mind, financial shields are made of physical gold and silver. And until next we meet, please be safe out there. Bye-bye.